One ETF has the potential to generate $500 in monthly income for Harry. His portfolio neighbor collects just $150. Fast forward 20 years, one strategy might build 3 times more wealth than the other. The bigger monthly check loses, because that fat dividend you're collecting right now might be quietly capping your future wealth. We're running the actual math on covered call ETFs versus Dividend Growth ETFs, year 1 through year 20. And I'm going to show you the exact moment when everything flips. Quick note: this is educational content about investment strategies, not personalized financial advice. All ETF data comes from current filings, but past performance doesn't guarantee future results. Consider your own financial situation and timeline. First, I'll break down how covered call ETFs generate those massive monthly payments. Then we'll examine Dividend Growth ETFs and why they start painfully slow. Finally, the decade-by-decade numbers that reveal which strategy actually wins. Harry's 38 years old. He's got $50,000 sitting in a savings account earning nothing. He wants passive income, real money hitting his account every month to supplement his salary. He's researching 2 completely different approaches. Strategy 1. Covered call ETFs. These funds hold stocks, then sell call options against those positions to generate income. The result? Yields between 10% and 13%. That's $400 to $540 monthly on a $50,000 investment portfolio. Strategy 2. Dividend Growth ETFs. These funds hold companies with track records of raising dividends year after year. Current yields? Usually 2% to 4%. That's $80 to $165 monthly on the same $50 grand. On the surface, covered calls demolish dividend growth. But there's a wealth-building principle that changes everything by year 15. And it has nothing to do with which fund pays more today. Let me show you the first fund Harry discovers. XYLD, the Global S&P 500 Covered Call ETF. Current dividend yield, 12.81%. On Harry's $50,000, that's roughly $535 per month. That's his car payment covered, or groceries. Real money, 12 times a year. Here's the mechanics. XYLD holds the stocks in the S&P 500, then sells call options on those positions. When traders buy those calls, XYLD collects the premium. That premium becomes your dividend. Sounds perfect until you see the trade-off. Those call options cap XYLD's upside when the market rips higher. Check the numbers. Over the past year, the S&P 500's total return was around 15.57%. XYLD's total return? 7.77%. Over 5 years, the S&P 500 delivered 106.06% total returns. XYLD, 50.06%. You're getting paid that fat dividend, but you're giving up half the market's growth. The expense ratio sits at 0.60%, higher than most passive funds. Harry's thinking, maybe that's fine. I want the income now. But let's see what happens when we run this out 20 years. Now Harry discovers the alternative. VIG, Vanguard Dividend Appreciation Index Fund. Current yield, 1.63%. On that same $50,000, Harry collects just $68 per month. That barely covers his phone bill and streaming subscriptions. It feels laughable compared to XYLD's $535 monthly payment, but here's what VIG offers that XYLD doesn't. Actual growth. VIG has delivered 11 consecutive years of dividend increases. Not one missed year. Every single year, the dividend payment went up. The 5-year dividend growth rate? 9.73% annually. That means your dividend payment doubles roughly every 7 years. And the fund itself grows. VIG's 5-year price return is 69.60%, keeping pace with the broader market. The expense ratio? Just 0.05%, one of the lowest in the industry. VIG holds 340 companies, all with proven dividend growth. Top holdings include Broadcom at 5.95%, Microsoft at 4.83%, and JP Morgan Chase at 4.05%. Harry's skeptical. He's staring at $68 versus $535 monthly. The income difference feels impossible to overcome. Let me show you another option before we run the numbers. Harry finds JEPQ, JP Morgan Nasdaq Equity Premium Income ETF. This one focuses on Nasdaq tech stocks. Current yield, 10.59%. That's $441 monthly on Harry's $50,000. And the recent performance looks stronger than XYLD. JEPQ's one-year total return, 17.18%. The three-year total return, 89.62%. This fund's been crushing it. Harry's thinking, maybe this is the sweet spot. Tech exposure plus covered call income. But look closer at the breakdown. JEPQ's one-year price return was only 4.78%. The rest of that 17.18% came from dividends. Again, you're getting paid big monthly checks, but the underlying portfolio barely appreciates. The expense ratio is 0.35%. Top holdings include NVIDIA at 8.35%, Apple at 7.24%, and Microsoft at 7.13%. Now let's bring in the remaining dividend growth funds. Harry adds two more dividend growth ETFs to his analysis. DGRO, iShares Core Dividend Growth ETF. Current yield, 2.04%. But check this, 10 consecutive years of dividend growth. The 5-year total return, 94.37%, nearly doubling the S&P 500's gains. Expense ratio, just 0.08%. DGRO holds 405 companies across sectors. Top holdings include JP Morgan Chase at 3.12%, Apple at 3.09%, and ExxonMobil at 3.04%. Then there's the fund everyone talks about, SCHD, Schwab, U.S. Dividend Equity ETF. Current yield, 3.80%, higher than the others while still focusing on growth. The 5-year dividend growth rate, 10.38% annually. And SCHD has delivered 13 consecutive years of dividend increases. The 5-year price return is 50.41%, and the total return hits 79.25%. This fund combines decent current income with serious dividend growth. The expense ratio? An incredibly low 0.06%. SCHD holds just 103 companies, concentrated quality. Top holdings include AbbVie at 4.13%, ConocoPhillips at 4.10%, and Chevron at 4.07%. Harry's got his 5 candidates, XYLD, JEPQ, VIG, DGRO, and SCHD. Now let's see what happens when he invests $50,000 into each and reinvests every dividend. I'm running projections based on each fund's historical performance patterns. XYLD and JEPQ maintain their current yields with minimal price appreciation. VIG, DGRO, and SCHD compound both dividend growth and price appreciation. Year 1. Results: XYLD, $56,405. JEP, $55,295. VIG, $54,098. DGRO, $54,182. SCHD, $55,390. Covered calls are ahead. Harry's collecting those fat monthly checks. Year 5 results: XYLD, $78,622. JEPQ, $86,541. VIG, $82,847. DGRO, $83,196. SCHD, $89,273. Still competitive. JEPQ and SCHD are neck and neck. But watch what happens at the 10-year mark. Year 10. Results: XYLD, $123,247. JEPQ, $148,931. VIG, $169,522. DGRO, $165,884. SCHD, $178,309. VIG, DGRO, and SCHD pull ahead. The dividend growth funds crossed above both covered call strategies. Harry's monthly income from XYLD is still higher, around $1,315 per month at year 10. But his SCHD portfolio? It's worth $55,062 more. And SCHD is now throwing off $716 monthly, growing every quarter. Let's keep going. Year 15. Results. XYLD, $193,158. JEPQ, $256,419. VG, $347,663. DGRO, $339,772. SCHD, $398,207. The gap explodes. SCHD's portfolio is now 2.06x larger than XYLD's. VIG sits at 1.80x. Even JEPQ can't keep up with dividend compounding. Now for the final number. Year 20. Results. XYLD, $302,847. JEPQ, $441,248. VIG, $712,589. DGRO, $695,441. SCHD, $795,966. Harry stares at his spreadsheet. His SCHD investment is worth 2.63x more than XYLD after 20 years. VIG is 2.35 times larger. Even conservative DGRO built 2.30x, the wealth of the highest-yielding covered call fund. But here's the kicker that changes everything. At year 20, Harry's XYLD portfolio pays roughly $3,225 monthly. He collected bigger checks than the dividend growth funds for the entire 20 years. But look at SCHD's income at year 20. The annual dividend from that $795,966 portfolio? Based on the current 3.80% yield and 10.38% growth rate, Harry's pulling approximately $31,247 annually. That's $2,520 per month, and growing 10% every year. XYLD's monthly income stays flat at $3,225 because the portfolio barely grows. Within 3 more years, SCHD's monthly income surpasses XYLD's, and SCHD keeps accelerating while XYLD flatlines. By year 25, SCHD is paying $4,067 monthly, while XYLD still sits around $3,300. Harry realizes he wasn't just comparing income strategies. He was choosing between money now and wealth later. Harry makes his choice. He splits his $50,000 into 2 buckets, 30% into JEPQ, $15,000 generating roughly $132 monthly right now. This covers some immediate expenses and keeps him psychologically invested. 70% into dividend growth. $35,000 split between SCHD and VIG. This builds his long-term wealth and creates compound growth. Because Harry's 38, he's got at least 15 years before he needs this money to replace his income. And the math shows that by year 15, his dividend growth portfolio will be throwing off more income than covered calls anyway. If Harry were 65 and retiring tomorrow? Different story. He'd weight heavier toward covered calls because he needs the income now and doesn't have 20 years to compound. But Harry's playing the long game. Your timeline determines your strategy. If you've got 10 to 15 plus years before you need significant passive income, dividend growth ETFs will build substantially more wealth. The dividends compound, the share prices appreciate, and by the time you need the income, you're pulling way more money from a portfolio that's 3 times larger. If you need income today, you're retired, semi-retired, supplementing earnings right now, covered calls make sense. You sacrifice growth for immediate cash flow. That's the trade-off. And now you know exactly what it costs over 20 years. If you want my breakdown of the top dividend growth ETF for building long-term wealth, that video's right here. I walk through the exact holdings, the dividend growth history, and why this fund keeps beating the market. Your future self will thank you for understanding compound growth today.